Zero-days-to-expiration options offer traders a chance to make a quick profit off a small price change in an underlying security, but can also quickly lead to substantial losses. They started trading in 2022 and in 2025 made up 59% of the index options on the S&P 500. The market for zero DTE options continues to grow, including some exchange-traded funds and stocks. They may have a unique draw because they can provide traders with an opportunity to capitalize on price moves in a short amount of time. They also tend to have lower premiums compared to longer dated options, which can make them less expensive when targeting short-term volatility. The fast time decay and the potential for quick returns of zero DTE options may be a draw, but there's a lot to consider before you start trading. Leverage is a two-edged sword that can cut both buyers and sellers. While zero DTE options are relatively new, if you think about it, every options contract on an underlying optionable index, stock, or ETF becomes a zero DTE contract on its expiration date. In the past, there were only expirations once a month or once a week, but now there are options that expire every day. So while the concept isn't new, it's important to remember that short-term options can experience significant price swings right before they expire. One important difference between index options and equity options is how they settle. Index options settle in cash, whereas equity options, like those used for ETFs and stocks, settle in shares of the security. So why would a trader consider an option with the average lifespan of a mayfly? Well, there are a few reasons. First, they can provide the potential of big profits for long option traders. Imagine the SPX was trading at 74.25 and a trader bought a 74.25 at the money call option for $7. The index rallied 1% to 7,500, and at the end of the day, the call option might be worth $75 for a profit of about $68, not including commissions or fees. That's a more than 900% gain off a 1% move in the index. But remember, options cut the other way too. If the price of the index fell or even stayed the same, the trader could lose their entire investment. Second, they offer a quick time decay for option sellers. Once again, imagine the SPX was trading at 74.25 and a trader sold a 74.15 put for $3.80. If the index were to rise, go sideways, or even come down to 74.16, the trader could keep the entire credit. However, if the index fell below 74.15, the trader would begin to incur losses. While initially the losses might only erase the gains from the sale of the put, the losses could grow quickly. Unlike the first example, a trader could lose substantially more than their initial credit. If the index fell 1% to 73.50, the trader would lose $6,120, not accounting for commissions or fees. Additionally, the margin requirement for selling index options can be substantial, and traders are required to maintain sufficient account equity for the short position. Third, zero DTE options are potentially less expensive compared to options with more days to expiration because they have less time value. This means that time decay will work faster. For this reason, it's especially important to make sure that if you trade zero DTE options, you do so consistent with your risk appetite. And finally, due to the high volume, the bid-ask spreads tend to be tight. Tight spreads can help lower trading costs. There's risks to these trades though, which work mostly like regular options, but on a truncated timetable. The options Greeks can provide insight about the risks of zero DTE trades. The Greeks are theoretical measurements of how a contract is influenced by changes in price, time, and volatility. The Greeks for zero DTE options are the same as longer dated options. Long calls have positive delta and gamma, negative theta, and positive vega. But what you must be prepared for is that many of these values are much higher than longer dated options, and some change quite a bit throughout the day. That means that a trade can turn positive or negative very quickly. One important factor is time decay, which is measured by theta, the rate at which extrinsic value melts. When the option gets closer to expiration, it melts faster. Because zero DTE options are so close to expiration, time decay will occur at a higher speed than longer options, and that speed can increase throughout the day, diminishing the chances that a long trade will succeed if it hasn't already happened. If a long call trader doesn't get the immediate move to the upside they were hoping for, they may consider closing early to avoid potentially losing all the invested capital when the contract expires. At the same time, zero DTE options become more highly attuned to the price of the underlying as the day goes on. That's because of an increase in gamma, which tracks changes in the delta of an option. So in a single trading session, even a minor change in the price of an underlying asset of a zero DTE option can greatly affect the delta, which in turn changes the value of the option before it expires. Short option traders should consider gamma risk because late market rallies or sell-offs could turn a positive trade to negative very quickly. Gamma risk can also hurt long option traders because a change in direction could reduce profit and compound losses. Zero-days-to-expiration options are a popular but risky trading vehicle that are best suited for experienced option traders with a high tolerance for risk. Consider practicing trading zero DTE options using the Thinkorswim Paper Money platform before committing real money to your strategies. Also, consider developing a trading plan that defines when to enter and exit trades, as well as how much you're willing to risk on each trade. To learn more about trading options, check out our YouTube channel or go to schwab.com/learn.